Hi, I'm Leon Gorin, president of PEO Leadership, a peer-to-peer leadership advisory firm. We're an amazing community of CEOs, presidents, and senior executives. Ask yourself, are you learning as fast as the world is changing? It's time for Ontario business leaders to band together for counsel and support. It's time for you to tap into the business wisdom of our peer groups and unlock new ways to grow. I want you to come out of this COVID crisis a better leader and your organization ready for what's next. Take the first step at peo-leadership.com.
Welcome everyone to our live webcast today from PEO Leadership, where we've got with us Focus Asset Management, John Kustec and Greg Thompson, who will be joining with us today. Many of you are probably going, okay, for those that don't know about PEO in terms of how does wealth actually fit into the puzzle here, aren't you a group that's just helping individuals succeed around their businesses? And so wealth is actually one of the pillars. I mean, we talk about business, health, wealth, family, and career, and relationships, and all are equally important to us. And there's a belief that, you can be the greatest leader out there, but for example, if your health isn't with you, you're really of no value to your business. And so the same thing revolves around wealth in terms of, are we working to live, living to work, and whether you own the business or not, are you actually ensuring that you're building enough wealth? It's a sustainability, not just for yourself in times of retirement later on, but for some people, even from a multi-generational perspective. So that's our reason to sort of, one of the reasons that we watch this stuff, we care about it, and we're able to reach out to our educational partners here to sort of bring in some insights for us. I'd like to start, maybe have both Greg and John just quickly introduce themselves, and maybe one of you can just talk a little bit about Focus. Just give us a general overview about Focus Asset Management before we roll out.
Yeah, it's Greg here. John's going to carry the meat of the presentation like last time, which was about 3 weeks ago. And Focus has been in the current form for about 12 years. The clients have been with the firm for 20 or 30 years. And it was founded by a gentleman who brought Bob. His name was Bob Armstrong, and he brought John into the business many years ago. I joined 2 or 3 years ago. And really, we do one thing. We manage personal assets for high net worth individuals. We don't do pension funds. We don't do mutual funds. We don't do anything other than look after people's money. It's very conservatively managed, and asset class diversification is a big thing. And it tends to be a little larger than average client base. We've been successful in having a very high level of service, and we do that by keeping the numbers down in terms of clients, but we tend to work with clients that have accumulated wealth and are looking to preserve that capital as much as we want to grow it. But really, defense is probably the starting point of how we look at things. And I'll let John spend a minute on how he's evolved in this business as well, and then we'll jump into the presentation.
Sure, thanks, Greg, and welcome everyone. And I hope everyone is keeping safe at home and practicing all the measures that we've been asked to do. I've been in the business a long time, as Greg mentioned. I mean, the firm goes back 30 years, and that's kind of my history. I started essentially around the '87 crash, and I've been with a few different firms over time. But I've been with Focus for 9 years now. So we've got a really, as Greg mentioned, we've got a client base that goes back a long time, and I think that's important because that's how we want to build our business over time. It's building relationships with people, focusing on managing wealth for them and understanding their needs, and I guess more of that will come up as we go through really how we manage things and what we're thinking about markets over the next little bit. But that just gives you a couple of comments on my history and involvement. So maybe then what I'm going to do is, share my screen to get to the presentation that we have. Turn on the presentation. There we are. And so hopefully everyone can see now the presentation we're going to go through. It is similar to last time, so I'm not, for those who participated last time, I'm not going to necessarily spend a lot of time on each slide because a number of the slides are similar. We've updated the data, but I think we're just going to try to provide a frame of reference in that, you know, it's a lot's happened in the last few weeks, but in some ways, as we're going to talk about, not much has happened net in the markets because they're roughly the same as they were 3 weeks ago, albeit with incredible volatility from then to now. So we just did a bit of an introduction, you know, as Greg mentioned, in terms of the firm. The first couple of slides that we have here just tell you about the firm, the history, you know, assets, number of families. And so, you know, I won't necessarily repeat any of that, and we'll get to the market update. And, you know, I'll just mention a couple of things here that, you know, really what has changed in the last 3 weeks that would be reflected on this. One is the incredible amount of, you know, stimulus measures, whether it's central banks or governments have introduced in the last 3 weeks to respond to this coronavirus crisis. I mean, you know, the numbers are staggering, right? We're talking about, you know, $2.3 trillion package, you know, in the US, and that's in addition to the, you know, at least $1 trillion the central bank is throwing at markets to maintain liquidity and daily market functioning. You know, in Canada now, we're talking about the numbers having exceeded $200 billion in potential, you know, fiscal stimulus that the government's putting in addition to the central bank. So we are talking about numbers that you've never seen before in history that have been introduced to try to respond to this. Obviously, you know, in this early days, you know, no one necessarily thinks about, okay, well, what does this mean longer term for economies? But you can understand why, you know, that's not the concern right now. It's just getting us through this hump of essentially shutting down large part of the economy and then getting it restarted once we get through the health crisis. So, you know, I showed you last time, I flipped to the next page, which is US long-term interest rates, and really just to reflect that, you know, interest rates remain near record low levels, which, you know, is part of the stimulus measures, if you will. I mean, this is longer term interest rates. You know, the Federal Reserve has cut rates to near zero. We've had the same in Canada. And obviously, you know, low borrowing costs are part of, you know, what's ultimately hoped will help, you know, stimulate economic activity to return. I maintained the price of oil chart here that I showed last time because it's important here in Canada. I mean, you know, what did happen within the last few weeks was Saudi Arabia and Russia, or Saudi Arabia really initiated a price war because Russia wouldn't agree to cuts in the production of oil. And that had a disproportionate impact on the Canadian markets because on the day that, I think that happened on a Sunday, that's right, the news, and then on the Monday, it was the worst day in Canadian markets since the '87 crash, which is when I started in the business, as I mentioned earlier. And almost everything was tainted by energy in the Canadian market from that day, and has been volatile since. I mean, banks, because they lend to energy companies, energy infrastructure, even if they're not directly, you know, impacted by the price of oil, you know, they are energy companies, and obviously energy, you know, companies themselves, even utilities were getting indiscriminately sold off. So that single measure, you know, that's brought oil down to, you know, extremely low levels relative to history has really impacted the Canadian market in general. And you can see that in the next slide. So I did an update on, you know, it's tough to tell. I mean, the Canadian market dropped so precipitously, fastest decline in history, fastest bear market in history here in the US and most global markets. There has actually been a recovery. So you can see, and that's why I put this horizontal line here where this is as of April 1st, where the Canadian markets were. We were actually at the depths post that oil price war initiation, even lower than we were today. And so I made this chart a little longer term than the one I showed last time, because I think, you know, it's interesting. In the Canadian market, we're back to levels seen in 2013. I mean, there was a bear market in 2016, which was also an oil price war. We were down, you know, at similar levels, but, you know, so really we're going back, you know, 7 years where all you've earned is a dividend. And even though if you go back to 2008, obviously, you know, in the depths of the financial crisis, markets were even lower. So maybe that's a little worrisome in terms of, you know, where we could go if things get worse. prior to the financial crisis, markets were higher. So in some ways, I mean, this goes back to almost 2007. In the Canadian market, you've essentially only earned the dividend. So it's been tough slugging in the Canadian markets for quite a period of time. And the next slide shows the U.S. market, a little shorter term history. I mean, the U.S. market has been the outperformer globally since the financial crisis, but that hasn't stopped. As you see, the U.S. market from also experiencing its, the fastest bear market in history. It has recovered somewhat. It's a little easier to tell on this page, but it's still down 26% from its high in February. A slightly different valuation chart than I showed last time, because the one I used last time showed U.S. stocks relative to their earnings. But let's face it, earnings are going to fall off a cliff over the next quarter or two. So they're almost, I'll say it, a useless tool for figuring out how things are going to be valued, because when earnings drop, by 80-90% for some industries, then you really can only look backwards at how things are valued, and then anticipate, once you get through this crisis, will business return to somewhat normal, and then anticipate, figure out how you want to value things. But on this measure, I mean, we talked last time, the market was really expensive going into this. I think that's one reason why we've seen the speed of the crash given the crisis. So this is a Warren Buffett's favorite measure, which is market cap of total market cap of stocks relative to the size of the economy, and it actually had surpassed the internet bubble earlier at the peak in February, but clearly has corrected meaningfully since then. Hence, as we'll talk about later, we are finding some things to buy given the correction in valuations. Next chart just shows, I mean, it's interesting, like off the bottom in the financial crisis, 20-year history of the S&P 500 U.S. stock market, meaningful correction, but in the scope of other financial crisis market peak to trough was about 54%, almost 50% in the internet bubble. So given the magnitude of this crisis, we may not be done yet in terms of where the actual bottom settles in. We're not trying to make short-term market forecasts. We're just trying to assess risk and opportunity. And as I'll talk about in terms of some of the things we've done, it's why we haven't necessarily increased our exposure meaningfully to stocks yet. But what we have done is buy enough to offset the decline that has been experienced by stocks going down. And one of the things from our firm, we're a value-based firm. Doesn't mean and value can mean a lot of things depending on what industry you're buying stocks in, whether it's energy or industrial companies or others. But in general, in the internet bubble, when things cracked and the market went down, value ultimately outperformed quite a bit as we came out of it. We can't forecast for sure that would happen this time, but we think value had underperformed significantly for several years going into this crisis. So we'll see. It'll be interesting to see if this pattern repeats itself, maybe not to this dramatic degree. And then part of this, I guess, is our own, just to give you a sense of, because we are value-based investors on page 12 here, we were Harbor Capital at the time, so that's the blue line here, and it just shows that the internet bubble showed how we've got the line that looks like a mountain with in the middle is the NASDAQ, tech-laden stock index, clearly had rocketed into 2000 and then plummeted since. So for us, because most of our clients are balanced oriented, so they have cash, fixed income, equities mix. It was a challenge through 99 and early 2000. We felt things were extreme in the markets. We were saying so, and you're having some tough conversations with clients. But it wasn't that we didn't believe in what is happening in technology. As I've said to many people, I've had a focus on investing in tech stocks for most of my career. It's one of the first sectors I was assigned to look into. Everything that we said in 2000 about the use of tech came true. I mean, we did believe that ultimately we would all be doing, I mean, here I am at home. I've got my, laptop. I've got an iPad beside me, a cell phone. My kids watch videos in bed with their laptops on their chests. They don't watch TV anymore. All this came to be, but if you invested in tech stocks at the peak of the bubble, you did horribly for the next several years, and before ultimately we came out of it. So, there can be times where you have really good businesses that may keep on being good businesses ultimately, but they can be so overvalued they're not great investments for at extreme periods. I added a couple of new charts this time because one of the things that's really changed in the last 3 weeks is what's happening in credit-related markets. So this first one is about preferred shares, which are sort of quasi both. They kind of trade like equity, but they are lie in fixed income land as well. So preferred share market in Canada is largely dominated by banks, insurance companies, utilities, infrastructure businesses, and then a smattering of others. In general, one would consider it to be businesses that are ultimately going to pay their dividends, preferred share dividends over time, even through periods of market disruption. So what you see here is that this is Bank of Montreal's large, they've got a large ETF called the Ladder Preferred Share Exchange Traded Fund. And this is the yield on the preferred shares relative to the Government of Canada 5-year bond. The spread between how much more would you earn if you invest in this preferred share ETF. And you can see, the fact that this line has spiked in the last 3 weeks. This is the widest, exceeds now what happened in the bear market in 2016. So you can get the highest return on preferred shares relative to the Government of Canada 5-year bond, where rates have come down, than you could. And if actually I didn't have the data available to quickly update this chart, but it actually, this is going back to like financial crisis levels almost in terms of the spread on preferred share yields. So, some interest there for sure, if you believe ultimately that, we come out of this crisis, then these look somewhat attractive at this level. The other side is on what the next chart I've got is investment grade, sort of triple B, which is where a large part of the bond market resides, yields versus Government of Canada bond yields. And so again, on the far right of this chart, you see this big spike in the last 3 weeks. And our view had been, as you saw over the prior, from the financial crisis up until this spike, that, spreads were tight on corporate credit, and you didn't necessarily, other than briefly during the bear market in 2016, want to be in longer term corporate credit because we felt you weren't really getting paid for the risk. And now with this spike in spreads, clearly it's not at financial crisis level. So, it's a bit, you want to be careful, but I think there are opportunities starting to emerge in, higher quality corporate credits that, in other words, finding credit opportunities that, now's the time to start looking at this. So that gives you an overview of, and an update on some of our thoughts on markets. And I'm going to let Greg, as we talked about last time, just talk about, from a managing risk perspective, what we think in terms of, asset classes right now. And then I'll wrap it up after that.
Yeah, thanks, John. And then I'll get to Leon's question, or I think it was actually that you came off the someone in the chat room, but about would you be putting money to work here if you had a lot of cash sitting around? We'll talk about that in a minute. But I always like to come back to this one table. It just really drives home the point that having all your money in either equities or taking it all out is really not the way to go. The whole diversification strategy across different asset classes, equity and fixed income, makes complete sense. And then even within equity, it's not just, put it in the stock market or take it out. There are other forms of equity that provide good returns, but don't have the volatility. They might not generate 20% in 1 year like the S&P when it rockets up, but you know, you can get a 10 or 11% in things like infrastructure, and they're private types of opportunities, and we're doing some of that now for clients that really want to take a long, hard look at reducing the volatility in their portfolio. So I just want to touch on that. I think it's important that you know, we think about ways to insulate our portfolios so that when the world continues to evolve, that we're in a safe place financially. I would say, answering the question that is going to come inevitably, you know, if you had this big pile of cash sitting on the sidelines, how much would you put to work, or would you put it all to work? And we said last time, oddly enough, that you know, the market was at the exact same level, although there's been a lot of volatility and the environment has gotten significantly worse. You know, we said put a third of it to work at that point in time. I think that statement still holds for today. Like I wouldn't rush out. I don't think Focus is suggesting that we're not doing that with our clients' portfolios. We're waiting. That it's not so much about we know the markets will drop. We think they might, but the point is that the stocks aren't coming off a super cheap level. When the S&P 500 was at 33.93, the all-time high, that we found that a pretty rich valuation, and we're really only off that by about 25 or 26%. So we're still hanging back on our asset mix in terms of putting more money to work in stocks, simply because we're not down as anywhere near what we have been in historical terms on some of these more challenging events for the economy. And you know, it's interesting, at the start of this call, Anita was talking to Leon about rent and what different people are thinking about in there, and those are real issues that they're not going to go away for the next month or the next 2 months. And so we do have some concerns about how the economy is going to behave here, and we don't think that that's fully discounted in terms of how the stock market in particular has reacted. John, I'll turn it back over to you now.
Okay, thanks, Greg. So the last slide really is just sort of our wrap-up comments. And, you know, I guess the first thing I'll say is, I mean, there's been a lot of, you know, if you're watching the news, people trying to guess like how deep the recession is going to be. I actually think it's irrelevant, the numbers. I mean, we know it's going to be deep, as I mentioned in the beginning. You know, we're shutting down, in some cases, virtually entire industries temporarily. So whether the economy is down 15% or 20%, I don't think matters. I mean, what matters more, you know, can we respond to carry ourselves through this period, and do we think we're going to get through the other side? You know, I'm an optimist by nature. I think human nature is that we always respond to crises. We may panic at the beginning, which is what we've seen in markets, but ultimately people adapt to the situation. And I think that's certainly what I see when I'm, you know, had to go out and get my groceries or walk the dog or whatever, in terms of, you know, people, you know, doing their best to adjust to the situation. And as I mentioned, I mean, central banks and governments, you know, have to do the things that they're doing now. I mean, everyone may not agree on exactly what they're doing and how much they, you know, are or are not providing, but the fact is, you know, they're trying to make sure, you know, markets are functioning, you know, people can be taken care of. I think one of the challenges for governments is they're announcing so many things so often that probably is a little bit of confusion for the average person or business on how do I get access to the things that I need in order to make sure, you know, I can keep my employees paid or get through this. I mean, that is one of the things I think is a challenge over the next few weeks, keeping it simple, get the messaging out, and make sure that you actually implement the things to help people. You know, as Greg said, just in terms of markets, I mean, you know, what I mentioned earlier was, you know, we were fortunate that our asset mix was conservative going into this. Kind of hurt us last year with clients going, well, why weren't you more aggressive in what was clearly a strong year for markets? But we felt there was risk because of the valuation in markets. So, you know, as stocks have declined, I mean, really, other than a handful of stocks you've heard about, like Walmart or a couple of tech stocks, it's been a challenge. Like anything you own has gone down in this environment. It's been fairly indiscriminate. So you couldn't create a full basket of stocks that have been proven resilient here. So what we've done is, you know, as stocks have declined, we've been incremental buyers to bring our equity weight back up to what it was before. And we found opportunities to maybe buy businesses that are better positioned as we come out of this, than because they finally sold off somewhat, than perhaps some of the things we owned before. So both have gone down, but then you sell one that you thought would have been better position, but we hadn't predicted a coronavirus. So as you come through this, you do evaluate your holdings and go, okay, well, I did like this business before. Another one that's, we think is really good has sold off, and let's reposition into that one as we come out of this. So that gives you a general sense of what we've done, and hopefully, giving you some perspective on what we think about markets and the economy from here. And we're happy to take questions.
Thank you, John, and thank you, Greg, for that. It's interesting. I look at things in two buckets, and what's I think really important, and you touch on both of them, is today the preservation of capital is very important to everyone on that call, to all our members. That's what I worry about is, don't lose the hard income, the hard money that you've earned over all these years and built up, and that preservation. And then the other opportunity, obviously, that you hear about is the potential now to creation of wealth. And I love the way you guys have been positioned. This is your time, actually. The previous years have not been your time. This is the time for Focus Asset Management, because this is how you look at investments. But coming back to the preservation piece, John, you showed those charts, right? 3 weeks ago, we sat here, we're at the same level. We look historically at what's been done, what bottoms have been in the past. And if I'm thinking about preservation mode today, we've never seen anything like this before. Like, everything is shutting down around the world. The market's holding, it's been unbelievably resilient. It actually doesn't even make sense to me why it's sitting even at the S&P at 2,500. Like, what are your thoughts? Like, is there another potential here for another 20% drop? And it sounds like you guys are contemplating this as well, because you're edging in slowly as well. But that's my big concern here, is if I'm trying to worry about my members and the preservation capital, and I look historically, nobody's ever seen anything like this thing, and they're pumping tons of money in, but tell me when we're going to get the check. What's the risk? We're going to really come down another 20 or 30 points percentage.
Yeah, I'll make a couple of comments. Maybe Greg can pipe in. I think back to the last two, big market declines that I showed earlier with the S&P 500. Like, the financial crisis was similar in that everything went down in the financial crisis. Now, if you're a Canadian investor and you had foreign assets, one benefit that happened then was, if people remember, the Canadian dollar was actually in the mid-90s going into the true, fast decline in late 2008. And it plummeted down to like 70 and ultimately down into the high 60s. So if you had foreign assets, you got the benefit of the plunging Canadian dollar, maintaining the value of them. And that doesn't exist today. The Canadian dollar was at roughly 75 going into this. So yes, it's come down a little, but that's one difference. But the similarity is that, there was almost no equity, part of the equity market to hide in. In some ways, this market is a little more like the internet bubble cracking. Like, we had some, really good, we all know, like, the FANGs were leaders coming into, the peak of the market, with trillion-dollar valuations on Microsoft, Apple, and then, other businesses. And, again, these are good businesses, but in the internet bubble, ultimately, highly valued companies that hung in initially, cracked, and those, and again, they were good businesses ultimately all the way through, but the valuations really gave up a lot in the end. So I think yes, there is a risk, and we're very cognizant of it, that the market could go down another 15, 20%. And I think that's a real risk. But when you look at how many stocks have been beaten up by 40, 50% here already, there still is a bit of a bifurcation in that there's a lot of stocks that probably have as much economic impact as stocks that have been beaten up much more, but it's not priced in yet. So I kind of think that the next wave might be, stocks that people felt were going to be more resilient, but ultimately are going to be impacted just as much as almost any other business. And that could be what the next downturn, or if the market does go down 15 to 20%, what you start to see reflected.
I think what John's saying is that it's always, for the last 10 years, it's been more about just put money to work in the market, and the bigger stocks got bigger, and the FANG stocks became incredibly large. And I think we're at the front end of an era where active management, I know it sounds like we're preaching our talking from our own playbook, but where active management is going to make a big difference, because the names that grew, outsized compared to their earnings growth were the top 10, 15 stocks in the S&P 500. And that's similar in a way to what happened in 1999, in the internet bubble. The top stocks took in the vast majority of the money. And when the market rolled over, 50%, there were many stocks like Sun Life, just, that real companies that actually went up in value. They're like real businesses that were valued up in that market drubbing. And we're starting to see a similar thing unfold where there's some really good companies that will be in business, the industries that they're involved in, whether it's moving, corn around a distribution system or something like this. It's a fundamental part of the economy. They're dirt cheap now. And so we're happy to buy them here. And I think I would be a little bit leery of buying an ETF on the S&P 500, frankly, but in terms of buying real businesses, they're down 50, 60% from the peak. We're pretty comfortable in that.
Funny, I've heard the same thing. The ETFs, the move towards active management and during a time like this, it's really, attitudes are really changing on that. What advice would you give these members that, they look at their portfolio today and they say they're not sure what they're holding? Well, a lot of them probably holding ETFs, but even on the companies that they're holding, how do they know they're holding those that they think, because they're not doing the work and the investigation on these companies, that be the ones that are actually the ones that they should continue to invest in, or maybe they should be selling because there's even a higher risk that they may go further down. So for example, I picked Canadian banks, right? They seem fantastic, but none of us really understand the exposure to the oil industry, the bank loans. Will the government come in? Are they truly backing them? So any advice to people if they're going to review their portfolio today? Any advice on what actions they should take?
Maybe I'll start. I'm going to make a comment on Canadian banks. We haven't had large exposure there, and not because they're bad businesses at all. It's just that we felt the reasons that had provided growth over the last sort of decade, housing market boom, and they had big wealth management businesses. So, the fact that markets were booming were very helpful. We're less likely to be, as good over the next several years. Now, having said that, we do benefit from an oligopolistic structure, better capitalized banks today than they were going into the financial crisis. So, and, let's face it, banking is still integral to the smooth functioning of the economy. So while, the opportunities for growth weren't going to be as good over the next several years, we still do believe that the banking system, is, as I said, it's integral. It will come through this period ultimately. It may be that if things get worse, the governments ask, like they have in Europe, for banks to temporarily cut dividends, as an example. I mean, all the banks have given pretty solid reasons why they don't feel they need to or they can withstand this period, and we think they probably can. So I wouldn't view it as banks are at risk. Ultimately, I think they will come through this, as with most businesses. I'm probably most worried about those that are most reliant on discretionary spending of consumers, because you're going to come through a period now where a lot of consumers are going to be stressed. And even when the economy resumes, I would suspect that over the next 12 to 24 months, the average consumer is probably going to be a little bit wary about making significant discretionary spending decisions over that time period, because you're uncertain about is coronavirus going to return, or is there going to be these multiple waves that people talk about. So that's probably, in general, probably most concerned about businesses that rely heavily on discretionary spending of consumers.
No, that's great. It's very helpful.
I don't know, Greg, do you have any additional thoughts?
No, that makes sense to me.
Yeah. Any questions from anybody in the audience who's online right now? Please just come off mute and feel free to ask any questions. You got some great individuals on the phone here who can certainly try and answer your questions. Before we head into the Q&A portion of this webcast, First, a brief note about PEO leadership from one of our members.
I was made president just before COVID-19 lockdown began.
Nelson Fresco, President, Mila Canada.
We pivoted by compressing our 5-year online strategy into the last 5 weeks.
Surprised? Don't be. Nelson is a member of PEO Leadership, Canada's premier peer-to-peer advisory firm.
PEO leadership helped me develop my ability to lead with speed. We've seen a substantial increase in online sales, and Mila offices worldwide are following our Canadian example.
The time to step up and lead is now. Go to peo-leadership.com.
A lot of chat about this generational opportunity. I don't know if you guys are hearing about it. Every financial call I get on, this is going to be the biggest opportunity of our entire generation to come out of this with creating wealth. What are your thoughts on that?
You mean in the equity market?
Yeah.
Yeah,
Or it could be everywhere, but it's really the equities that we've seen the dive.
Well, it's interesting how much attention, I keep going back to that slide. It's interesting how much attention when we talk about investing, the equity markets get, and yet and not because of the COVID-19, but if you go back even 5-10 years ago, the number of companies that are choosing to be in the public domain continues to shrink. And so, the first thing is there are other ways to get at equity-like returns versus the public equity markets, where you have to live through what we've been living through in the last, I guess, couple of months. But I don't know if I'd look at the equity markets the way we run our business and the clients that we have, and I think the type of person that joins PEO or Tiger 21, where they've accumulated wealth, they're about to liquidate a business that's growing nicely and give them some wealth. And in terms of the generational opportunity, I don't think it's there right now if we're talking about the public equity markets alone. And secondly, I don't think I would take that opportunity and roll in a lot of hard-earned capital over many years to assume I could make that call. So I don't think it's the right point in time if I had to make that call, and I wouldn't ever make that call if I'd accumulated the kind of money that clients that want to have capital preservation front and center versus trying to hit for the fences in a major down dip. So when John and I speak about the equity markets and bringing more money into the portfolios, that's simply an asset mix call. Right now we're in around, for an average client, we're in around 50-50 between equities, which include not just stocks, but dividend yielding stocks in there as well, and fixed income. And we're going to hold that way if the markets continue to flounder here and sell off. I don't think you'd see us go a whole lot higher than 60 or 70%. So it's not to me about making a huge home run here if the markets sell off. It's about putting more of it to work prudently. So I don't think the right time is if somebody wants to roll the dice, Leon, and try to hit for the fences. I don't think we're there yet. But if we were down another, maybe below, it sounds morbid, but if we're down below, say, 2,000 on the S&P 500, I start to think about it more seriously.
Yeah, I think one of the things that comes back to, maybe I'm going to flip back a few slides to that long-term valuation one for a sec, on page 9, U.S. Equity Valuations. You look at the very left-hand side of that was kind of coming out of the 87 crash. And actually, interesting, if you take it back to the Ronald Reagan years in the early 80s, I didn't put that history. Next time, maybe I will, or send it as a follow-up. I mean, in a sense, that was the true, once in a two-generation opportunity. Then you could argue, okay, well, in the financial crisis, we kind of gave up most of that, and we had a once in a generation, because as I mentioned earlier, things sold off across the board to an even greater degree than we sold off now. And you think of, say, again, I just say Microsoft and Apple. I mean, the stocks are down, I don't know, somewhere between 20 and 30%. I can't remember the numbers off the top of my head. But Microsoft and Apple, Microsoft was down 65% from the peak of the internet bubble to the bottom in late 2002. And Apple was down over 80, somewhere like 82% peak to trough. So, those sound more like once in generation opportunities to me in stocks like that. So as Greg mentioned, I don't think that's happened sort of across the board enough yet that I would say that this is a once in a generation opportunity. And the second part is, I think, there's some long-term implications from this coronavirus, right? Like, do we have as much globalization? Will people onshore, some of their activities that were previously offshored to China and other similar regions? Was the oil market permanently impaired? Like, there's some things that we really have to sort out. And that's where really the big opportunities, like what new businesses, what emerging trends are going to create business opportunities that you want to participate in. We're spending a lot of time over this next little while, hopefully figuring out, some of those businesses are going to benefit over the next 5 years coming out of this crisis in a reshaped economy.
And Leon, at the risk of dragging out the answer too long, there are other ways to get at a more manageable risk profile and get returns that might not be that 20%. But, I mentioned infrastructure a few minutes ago, but there's something else. The credit markets are interesting. While not dislocated to the same extent that they were in previous downdrafts, they're getting there, and we're starting to see some really interesting opportunities there because it tends to be a thin market in Canada, and Air Canada, for example. Well, you can imagine that what their the rate of return was on their public debt issuance 6 months ago compared to now. And so we find that area quite interesting. We're not saying it's at a bottom yet, but we find it very, very interesting because it's a different look at things than trying to pick the bottom or near bottom on an equity market and hope that more buyers come in over the next 5 years and make sure that the stock price goes up even if the earnings go up, because that might not happen. It probably will happen. The credit thing is interesting. Like if you have a bond that's trading at par 6 months ago and now it's trading at 82 cents, you do your work and you have to be right that it's going to be refunded upon maturity, but that's a lot easier discussion than trying to figure out things 5 years from now in the stock market. And so we're not saying put all your eggs in that basket, but we find that type of work pretty interesting, and there's some very attractive returns there. And we're actually at the risk of being promotional, we're actually launching a credit opportunities product in a month. We'd do it now if we could, but it takes a month to get up and running because we would have never thought about doing this 6 months ago, like not at all. And it's just such an interesting area. It's kind of that's getting toward that once every 10-year opportunity that makes sense, and it tends to be an area of the capital markets that responds quite well when you just start to crawl out of an environment like this.
Greg, let me that's very helpful. Let me ask you a question. Come back to the active versus the ETFs today in this type of market. And I know you guys are active managers and stuff. What are your concerns if people are in these ETFs today in this type of market environment? Maybe John, you can answer this too. What should they be concerned about? And I've been a big ETF believer for years, and it's been always going up. But
yeah, I think there's two things to be concerned about. One is that when retail investors and passive investors head for the exits, that's the first thing to get sold because it was really where all the money was coming into the market, like all of the money. So it's that's going to sell the market, and the big names that rose with the capital flows come in are the ones that are going to get hit. And so my worry there is that as people exit the market, they're exiting the security that you own, and there's going to be, probably for quite some time, more sellers than buyers. The other thing that would worry me is that even when the mess is cleaned up, I'm not comfortable if I look into the top 100 names in the S&P 500, for example, that, I'd really be thrilled about owning them if I had to own any one of them individually. Like if I look at the earnings prospects and the valuations, I'm not sure that it's quite there. We're finding tremendous value in the mid section of the market in terms of capitalization. And so my concern is you just own the market, and it was a bit of a game where people got into it because it went up last week, and therefore more people go into it. And you're not really owning businesses at a reasonable valuation. And that to me is the number one thing that worries me about them versus active management.
Yeah, and I'll pipe in. So I'm going to just maybe offset that a little bit because I agree. That's been our conversations for a while now, that we think generically people were exposed to market-based ETFs without really thinking about what they necessarily owned. But I should say, it's not that the ETF market is going to disappear or anything like that. I mean, even we would have used ETFs opportunistically to get exposure to certain segments of the market. So, we think, the ETF market is going to continue, but I think perhaps some balance for people to understand that, you don't necessarily just want to have blanket exposure to something without understanding, what's the risk and opportunity. Like if you're just buying the US market, there are times when the market's very expensive, as it was in February, but then there's times when it's cheap. So if the market went down another 20% from now, we could tell you perhaps, hey, maybe if someone had a bit of money, maybe that is a way to get some exposure. So it's not that the market is terrible. We just think that far too much capital went into it, in particular over the last couple of years, and the market had become so big, it kind of was driving trading and became a self-reinforcing mechanism on the way up. And it's probably a reason why the volatility has been so hard on the way down, because as we know, if a bunch of people decide to sell their S&P 500 ETFs, then the ETF manager has to sell by the end of the day, all the money that's being redeemed into the market. And if the market's getting beaten up through the day and those trades have to settle by the end of the day, you're just pushing the market further down. So I think that's one reason why you've seen such dramatic swings in the market, since mid-February and clearly in the last 6 weeks.
Oh, that's great. Thank you for that answer. I'm going to, I think I'm going to wrap it up now, and just, thank you both for your time and energy. On reflection, it's funny, you learn a lot, really learn a lot by listening to you guys talk about the markets. And the one thing I learned pretty quickly, and I'm trying to sort of tell our members, is you guys do this as a full-time job, and it's very detailed. What may seem easy to you as you tell us about this stuff, but it's very difficult if you're not in the markets or we're running our own businesses to actually understand half this stuff or really be able to select stocks, unless they're perhaps in our own industry. But I mean, very few of us are into understanding the credit and all these types of different opportunities. So thanks for sort of opening our eyes to that. And also, I think opening our eyes to, as members, we really should be understanding who's managing our money and where is our money sitting today. And so it's a worthwhile question for everybody on this call to go back, sit with your wealth advisor, maybe as you're doing a Zoom call, but really get an understanding of what they're saying and compare it to what you're hearing as well. It's not a good time not to understand what you're actually invested in, is I guess the final point I've got.
No, I think it's a good point. I'd just pipe in with also, be patient. I will just share that a lot of our longest term clients, as we've been doing updates over the last couple of weeks, the first question out of their mouths is, well, what are you buying given the market decline? So, because they have been through previous cycles. And so, Leon, your advice was excellent, but I would just add in, don't panic. We do come through crises. There may be more pain to come, because we're certainly going to hear on a daily basis until we peak on the health side. More people have the virus, more people are unfortunately going to die, but ultimately we will come through it. So be patient, be disciplined. And as I said, I don't think people need to panic, but you still need to be conservative, I think, until we, get a little further way through this crisis.
That's great.
Thank you,
well, thank you very much, gentlemen.
Thank you very much.
And I wish you all a safe and hopefully a great weekend. I know we're kind of stuck at home, but we can still walk around the block.
That's right. My dog's getting more walks than it wants. So.
Take care.
It's unbelievable. The dogs are really happy these days.
Take care.
All right. I'm going to sign off now. Thank you all for joining us today.
I know.
Yeah. Be safe.